According to Lawrence Lepard in a Thursday edition of the Cafe Bitcoin podcast, the next leg down is upon us. He also said he believes this time is different. This time he believes money fleeing the market will go into hard assets. This means Bitcoin leaving that risk on tag into risk off. So the decoupling may be upon us. It is wild out there, as Stanley Druckenmiller has said. Is the market crashing? Is the recession here? What the hell is going on, and where does Bitcoin fit in all this? Let's dive in.
And my sense is the next leg down in the stock market is just about to begin. And I actually think that this could be one of those legs where the hard money assets separate from the stock market, that the liquidity coming out of the stock market actually goes into the hard money assets, because people are going to begin to realize that, the recession and downturn is going to be serious, and that brings forward the day when they have to pivot. But right now, as James said, they're not pivoting, and so it's a lot of confusion out there. I mean, I think Stanley Druckenmiller said it very well. He said this is the toughest macro environment I've ever seen in 40 plus years of investing, and 50 plus years probably for him. And I think he's right. I mean, it's extremely difficult. You got to know what you own. You got to know why you own it. I think there's another point to be made that's important, and that is that people think that raising rates is going to decrease inflation, but there's been an argument, and it's a good one, that says that arguably raising rates could increase inflation, because those costs get pushed through in a lot of other places, and people have to raise prices to compensate for the fact they're paying higher interest. And if part of the inflation problem is a supply problem, the way you generate more supply is you add more capacity. Well, the way you add more capacity is you make capital investments. Well, when capital investments cost you more because your cost of capital is a lot higher, you're not going to make those investments. So there's a lot of stuff going on, but my sense is we're months, not years, but months, short months away from this stuff starting to go in our direction in a big way, because the market will smell the Fed pivot long before it pivots. I mean, it always does. It always has. So that's kind of how I see it right now.
Man, Lawrence Lepard always dropping the sauce. Now let's get into some of this macro stuff and see what is going on out there. Starting with this article from February 20th, Recession Signal as consumers struggle to pay bills. As in 2019, we see many of the same recession signals from the NFIB survey, again combined with the high percentage of yield curve inversions. Notably, out of the 10 yield spreads we track, which are the most sensitive to economic outcomes, 90% are inverted. Give that bad boy a look. Many analysts suggest the economy may have a quote-unquote soft landing, or rather avoid a recession, primarily due to the continued strength in the monthly employment reports. While those employment reports remain strong, the rapid decline in growth has been a recession signal in and of itself. As we have stated earlier, the trend of data is far more important than the monthly number. And we'll have all these charts for you in the show notes as well. The massive drawdown in savings and rise in credit card debt supported the consumption surge in the U.S. economy. However, since the turn of the century, consumption slowed along with economic growth. What do you mean I'm out of money? I still have checks. So in red, we have the personal savings rate. That's not good, while consumption as a percentage of the economy has continued to rise. But how are they consuming? There's a large gap there. Here we go. A particular recession signal comes from the massive surge in savings due to the stimulus checks. That boost has fully reversed as consumers struggle to pay bills. Currently, near 40% of Americans are having trouble paying bills. 68% of people are worried they wouldn't be able to cover their living expenses for just 1 month if they lost their primary source of income. And when push comes to shove, the majority, 57% of U.S. adults, are currently unable to afford an emergency. When broken down by generations, Gen Zers, 85%, and millennials, 79%, are more likely to be worried about covering an emergency expense. Then we see the bar consumer credit per capita, in green the gap between real DPI and cost of living, and the orange the filling of the gap, negative 7,500 in the hole. So that means nearly 3/4 or 72% of middle-income families say their earnings are falling behind the cost of living, up from 68% just a year ago, according to a separate report by Primerica based on a survey of households with incomes between $30,000 and $100,000. A similar share, 74%, said they are unable to save for their future, up from 66% just a year ago. As the Fed continues its aggressive rate hiking campaign, those short-term rates feed through to variable rate debt, such as credit cards. such as why a recession signal we should pay attention to is the sharp spike in credit card payments, which further detracts savings and wages from consumptive spending to debt service. And here we have the combination of record high credit card debt and record high credit card interest is nothing short of catastrophe for both the U.S. economy and the strapped consumer who has no choice but to keep buying on credit while hoping next month's bill will somehow not come. Unfortunately, it will, and at some point in the very near future, this will also translate into massive loan losses for U.S. consumer banks. That's when Powell will finally panic. That from Zero Hedge. The Federal Reserve has never entered into a rate hiking campaign with a positive outcome. Instead, every previous adventure to control economic outcomes by the Fed has resulted in recession, bear market, or some event that required a reversal of monetary policy, or rather, a hard landing. The whole point of the Fed hiking rates is to slow economic growth, thereby reducing inflation. As such, the risk of a recession rises as higher rates curtail economic activity. Unfortunately, with the economy slowing, additional tightening could exacerbate the risk of a recession. The media and the White House have proclaimed victory by stating the first 2 quarters of 2022 were not a recession, but only an economic slowdown. However, given the lag effect of changes to the money supply and higher interest rates, indicators are pretty clear. Recession risk is very probable in 2023. The consumer is likely to be the biggest loser. And here from MSN, U.S. recession risk at its highest in 40 years. Why is the stock market ignoring the economy? The New York Fed U.S. recession probability index based on Treasury spreads. The New York Fed's U.S. recession probability index based on Treasury spreads is currently sitting at its highest level in more than 40 years, even higher than its peak prior to the bursting of the dot-com bubble and the 2008 financial crisis. That's not good, Cotton. It's not that they are in denial about the possibility of an economic downturn, rather they are anticipating a shift in monetary policy because of the recession the model is so clearly predicting. But the market has gotten offsides trying to front-run that Fed pivot a couple times, and as the inflation rate has come in a little hotter than expected, they're having to pump the brakes on that pause, possibly. Let's continue. The bond market is currently pricing in 3 more 25 basis point hikes in March, May, and June. However, the Fed may be forced to pivot from tightening to loosening monetary policy sooner than expected if the economy falls into a recession quickly. Now, with all this bad news, there was some interesting developments this week. February 21st in Bloomberg, Bitcoin breaks away from stocks in 50% surge, defying macro peril. Bitcoin's year-to-date gain has now reached 50% after a further jump in February, contrasting with the retreat in global equities this month, courtesy of a macroeconomic environmental replete. Bitcoin's year-to-date gain has now reached 50% after a further jump in February. This divergence has dented a positive correlation between shares and crypto that sprouted in the pandemic. A 40-day correlation between Bitcoin and the S&P 500 has slid below 0.3 to the lowest since 2021 from a May record above 0.8. A reading of 1 implies assets are fluctuating in lockstep, and -1 signifies the opposite. Other relationships have shifted too. A deeply negative 40-day correlation between Bitcoin and a dollar gauge is rapidly disappearing. The January's tight tie between treasuries and the largest digital asset has dissipated. And there's more. This one from BN Crypto. Bitcoin and S&P 500 correlation turns negative for the first time since the FTX collapse. This is from February 23rd. The daily correlation coefficient between Bitcoin and SPX entered negative territory for the first time since November 2022. So this goes back to what Lawrence was talking about, liquidity flowing into hard assets. And no harder asset, no harder money than Bitcoin. Previously, the positive correlation held for 11 months since December 2021. Will the decoupling from traditional markets renew the narrative of Bitcoin as a hedge against inflation? We know fundamentally Bitcoin is a hedge against inflation. But with all this talk of the mirrors between the market behavior today, what's going on, the nervousness, and the correlation to the '08 crash, what is the housing market look like and what can we draw from that? Housing market crash. How soon will one happen and what cities could be impacted the most? So let's dive into it. High mortgage rates, inflation, and low supply have made the road to homeownership very difficult as late. While home prices seem to be cooling down, some experts are warning that a potential housing market crash might be on the horizon. Very interesting. So what is going on in the housing market? According to the New York Post, such declines would rival those seen around 15 years ago during the Great Recession. However, Goldman Sachs added that this national decline should be small enough as to avoid broad mortgage credit stress, with a sharp increase in foreclosures nationwide seeming unlikely. So while current conditions don't point to a housing market crash, a few factors could lead that way, according to U.S. News and World Report. These include a drastic increase in unemployment, prolonged housing shortage, and lower overall demand. And then we have this one from Forbes. The housing market downturn wipes $2.3 trillion in value as experts predict prices could still tumble another 10%. The '08 vibes are strong. The total value of U.S. homes have fallen from a record high of $47.7 trillion in June to about $45.3 trillion at the end of last year. This is the largest June to December drop since the subprime mortgage crisis was unraveling in 2008. Real estate brokerage Redfin reported on Wednesday. Though home prices are up about 1.5% over the past year, the median price has fallen about 11.5% from the peak of $433,000 in May to $383,000 in January, as higher mortgage rates, fueled by the Fed inflation-fighting policy, drive up borrowing costs and sideline potential home buyers. Last week, U.S. home purchase applications fell to a 28-year low. It is not looking good. Prices are likely to only fall further. The big story of 2023 will be the speed and extent to which the decline in prices follows suit with the collapse in existing home sales, which have plummeted nearly 40% from their pandemic peak, says Pantheon macroeconomist Kieran Clancy. Pantheon ultimately projects home prices will fall by another 20% from their peak by the end of this year, suggesting a median price could tumble another 10% to about $346,000. Okay, we've got a couple more here. This one from Markets Insider. The U.S. housing market could be close to bottoming out as existing home sales plunge to their lowest level since 2010. Maybe that's hopium for those guys. Existing home sales are at the lowest level since 2010, according to data from the National Association of Realtors. The slip in January notches the measure's 12th straight month of declines, with existing home sales plummeting 36.9% over 2022. The latest drop brings existing home sales to their lowest level since October 2010, when housing activity was still reeling from the mortgage crisis of 2008. Man, sometimes history doesn't always repeat, but it does rhyme. Here's an article featured in Simply Bitcoin Unfiltered by Macro Minutes, and I think he has it pretty good. Real estate investment straight ahead or double down on Bitcoin investors in 2023, veering to that hard right. Now, Macro Minutes breaks it down in detail here. Let's look at a couple of his charts. So here we have the homebuyer mortgage payments plus 27.8% year over year. The only way this could possibly be sustained is if people are getting pay increases at faster rates than have ever been seen in U.S. history, or families will have to allocate the majority of their monthly income to a mortgage, meaning they will have to lower their quality of life in other areas in order to just afford their homes. Home price versus median household income is the best way to track housing affordability. Even with the recent cool down last year, we are still at historical highs for this very important metric. This means even if rates come down in 2023, there are major headwinds for the housing market. But what about Bitcoin? Let's check this out. Here we have the reserve risk. Reserve risk is a Bitcoin chart that shows the confidence of long-term Bitcoin holders in relation to its price at a given time. The green zone indicates high confidence and low price, representing an attractive risk-reward ratio for buying more Bitcoin. Conversely, the red zone indicates low confidence and high price, making the risk-reward unattractive. Historically, buying more heavily in green zones has been optimal if you're trying to get the most amount of Bitcoin possible. In summary, if you or someone you know is trying to figure out if you should buy an investment property versus more or their first Bitcoin, the markets could not be in more opposite positions than they are right now, meaning that Bitcoin is in bargain territory while real estate might be getting wrecked in the near future. Man, it is wild out there. Buckle up. Here, let's get to some of the tweets. Despite all that lovely lovely talk of decoupling this week. Bitcoin recoupled with SPX pretty damn fast. So who knows which way we could be going? I think I lean towards Mr. Lepard personally. Other things that are completely sustainable. Here is an eye-opening chart. Nominal GDP and public debt. This is not sustainable without financial repression. That has to pay for that. That has to pay for that. That has to pay for that. Germany, I guess you're not too bad. How with your energy crisis? That's wild. UK and Spain are screwed. My God. Hey, U.S. 130% debt to GDP, so we can't say shit. Here we go from Bloomberg, just talking more about the macro situation. More Americans are getting a second job, and it isn't necessarily a sign of financial hardship. You work 3 jobs, but it's good for you. Inflation's good for you. Inflation's good for everyone. It's good for the country. It makes the economy stronger. I don't know, Bloomberg, but probably not gonna make it. Now, this one from Michael Green kind of goes back to what we were discussing yesterday on deflation and Jeff Booth and that thesis. But you want low inflation? You do what we've always done. Add low-cost baseload power and let people figure smart stuff out, meaning let the free market go to work. No better way to empower the individual and fuel the free market than with the hardest money ever created, Bitcoin, and adopting the Bitcoin standard. Talk about a boon on humanity, as Beautyon would say. And he's kind of been calling for this quite often lately. That piece of shit Jamie Dimon says the U.S. economy is facing some scary stuff ahead. Not surprising, that's in Bloomberg. Will be in the notes for you. All of the content will be in the notes. Always know you can go catch it down there or dig deeper. And fiat crushes the middle class as sound money grows the middle class. Middle-class American parents say they want to raise kids on one income, but many don't have a choice. And this is what we've got to. We're on the rat race. You got to run 3 times as fast like you're down in the Red Queen territory just to keep up with inflation and what the state is doing, stealing from people, and they force you to use this money. It should be criminal. And Breedlove couldn't be any more right. Show me a better visual metaphor for central baking. Captain Karsten's Gordo right here. Look at this thing. My God. That guy uses the driveway to iron his clothes, but he wants to tell you how to spend your money. How many buffets did he drive to bankruptcy? And as they were talking about banning emojis or some shit the other day, Lavish put this out. So if I use a rocket to explain this chart, would the courts look down upon that too? And this is the government expenditures and interest payments. That should be fine.
Gresham's law is going to kick in, and Bitcoin is going to go to 50,000, 100,000, 150,000, 500,000, 1 million, 2 million. 10 million. I mean, in the space of, days, weeks, months, which will basically be the event which says fiat has failed.
Will there be a soft or hard landing in the economy? Let us know what you think in the comments. Let us know on Twitter. And don't forget to like, subscribe, give us a pump, spread this signal, orange pill your family and friends using that Simply Bitcoin content. If you want to learn more about Bitcoin, about macro, check out these videos. Buckle up. Make sure you're stacking those sats as the end days of the Keynesian experiment are upon us. Until next time, guys. Peace.